Think about two countries. One is a surplus country. One is a deficit country. Deficit and surplus in the sense we've always used in this class, which is in terms of payments, okay? That the deficit country has bought something, okay, from the surplus country, and it now has $10 due to, okay? It has to make a payment, okay? It has to make a payment. Remember, go back to the clearinghouse and all that. The deficit country has to make a payment to the surplus country. The surplus country has a $10 due from. Okay. And notice that I'm saying dollar, okay, because I'm thinking this is the kind of world we live in where this is the reserve currency. This is the international reserve currency. Neither of these countries is the US, let's say. Neither of them is the US, just to get that off the table. These are just, but they're paying each other in dollars. There needs to be a dollar payment. If the deficit country had $10, okay, that wouldn't be a problem. Okay, you just send it along, or you have a bank account and you just transfer it or something like that. But of course, that's not, that wouldn't be interesting for analysis. Okay, what we're interested in here, as we always were when we were doing the payment system without any exchange rates, okay, is suppose I don't have $10. Now what? Okay, does that get in the way of this transaction? Right. The whole point of a payment system is to make sure that it doesn't, okay? That willing transactors, somebody who wants to buy and somebody who wants to sell, are not inhibited by the fact that they don't happen to have the means of payment on them right now, okay? And what is the way they got around that when we're talking just about domestic? It was always some form of credit, right? Some form of credit. Either credit on the balance, ultimately credit on the balance sheet of the central bank or the clearinghouse, or money market credit. You know, I'll promise to pay you tomorrow, okay? Or 3 months from now or something, okay? I don't have money now, but I will later. And so credit creates elasticity that makes the payment system go. When you're talking about foreign exchange, it's a little more difficult, okay? But let's introduce credit. Let's introduce a foreign exchange dealer here in the middle between them. How can this foreign exchange dealer help? Okay. This foreign exchange dealer can help by selling dollars to this country. This country has his own currency, okay? And so he wants to use that own currency, sell his own currency to the dealer, okay, and use it to buy dollars. That's the whole idea here, okay? So what this guy does, he takes $10 times the exchange rate, E, so that's how much of his of the foreign exchange, and he sells that, okay, so that's a minus, in order to make this payment. Okay? The foreign exchange dealer buys it. So this is a quantity of foreign exchange here. And the FX dealer sells $10 of actual dollars to the deficit country. $10 spot, okay, which is which gets rid of this due from. The due from is replaced by $10 spot. Okay. So now, so the payment has been made here. These promises to pay here have canceled. Okay. From the point of view of the surplus country, he's been paid. He has $10 spot. He has $10. Okay. From the point of view of the deficit country, okay, he has paid. Okay. He's given some of his own currency. And so they think they're off the hook, okay? But the FX dealer is the one who actually made this payment. Okay? The FX dealer accepted foreign exchange and paid dollars, okay? And the dollars he paid, he created from nothing. Okay? They're just promises to pay dollars. Mm-hmm. Yes?
Yeah, but if he took the dealer took $10 from deficit country and he made a payment of $10 to surplus country.
Yes?
But why is then liability? It shouldn't be just the change in assets of the dealer?
No, I'm showing him expanding his balance sheet. I'm showing him not having, I'm trying to show this as credit, okay? So yes, it's true that he'll have inventories to be a dealer, okay? But what makes the dealer go is his ability to move, to take short and long positions. And I'm showing him taking a short position in the dollar, which is the counterpart of this long position in the dollar here, and taking a long position. This is foreign exchange. This is the quantity of foreign exchange, So in fact, let me take the dollar sign off there because that could be confusing. It's 10E quantity of foreign exchange, and this is 10E quantity of foreign exchange. So the point is that he's operating just like a bank operates when we are talking about without foreign exchange, right? That the bank is making the payments that the people can't make, and then it's taking all the risk. And look at the risk this person is taking, okay? Well, just like any bank, there's a danger, he's acting like a bank, that in fact this surplus country will demand payment of that spot dollar, okay, not as a liability FX dealer, but as currency or something, okay, that wouldn't be good. That wouldn't be good, okay, because this is just a foreign exchange dealer here. So that's a problem. The FX dealer, I'm going to show, it can hedge that risk, okay. In the term market, I'm going to just say, let's suppose that we have $10 term deposit. Suppose that the FX dealer trades with other dealers, as we're going to see in a minute, a term deposit here, and 10E FX term deposit here. Okay. This combination, this serves as a hedge for these spot, for these foreign currency exposures in the following sense: that if the exchange rate between the dollar and the foreign exchange here, this foreign currency moves, then you win on one side, and whatever happens to one side happens to the other side, and so they net out. Okay, you've got a dollar asset and a dollar liability. You've got a foreign exchange asset and a foreign exchange liability. And if you think about the exposure here, you're taking advantage of the forward interest parity condition here. Okay, these interest rates here are the term rates. Okay, on the term positions. This is the exchange rate on that you use to create this spot. So you've essentially hedged your spot position in the forward market at the forward rate. The reason I'm showing it this way is to say this is a matched book dealer, matched book foreign exchange dealer, and there's a huge volume of this kind of trade that goes on. Foreign exchange trading, daily volume, is $4 trillion. It's huge. It's really, really huge. It's one of the largest markets there is. In order to balance this balance sheet, though, there has to be somebody else, and I'll just put them underneath here, who's taking the opposite side of this. Term deposit here, and 10E FX term deposit here. Okay, this is a speculative dealer. Okay. Now, so let's now go through this once more. I'm showing, there are a couple of steps here, how foreign exchange dealers can help the real economy make payments, okay, by making the payments themselves, okay, and then hedging the exchange risk in the forward market with people who are willing to take that risk. Okay. So you see this and this are the same thing, this and this are the same thing, this and that are the same thing, this and this are the same thing. So every asset is somebody else's liability in this picture, but I'm showing the functionality is different, okay? There's a matched book dealer who's not taking foreign exchange risk. They're taking another kind of risk, as we'll see later on, not today. And here's the speculative dealer who we kind of recognize from our trainer model, okay? You know, that here's somebody who is who's taking foreign exchange risk and has to be compensated for that, okay, by some notion, and they're exposed to the forward rate. So it's this sort of thing that moves the forward rate away from the expected spot rate, because there has to be an expected profit here. You could think of this person, this first dealer, this matched book dealer, as a forward interest parity dealer, this second kind of dealer as an uncovered interest parity dealer. All of this we're going to do with charts and graphs, okay, in a week or two, okay? But I think it's better to put it out there so you can see we've talking about the payment system. This is from the very beginning of the course, but now we're talking about foreign exchange payments. We're talking about market makers in money, okay? But now we're not talking about you know, term funding markets, we're talking about forward exchange markets, okay? But the same concepts are what is going to drive our understanding of what determines the exchange rate and what determines the forward rate. It's the same style of thinking that's going to come into play here.